Welcome, everyone, to Simple Mind Space. Today, we're diving headfirst into the fascinating world of finance and economics. Whether you're looking to make smarter investments or simply want to understand the global financial system better, this episode is for you. We'll be covering a wide range of topics, from the fundamentals of business and capital markets to the intricacies of valuation, financial statements, and macroeconomic trends. Get ready to unlock the secrets of the financial world and gain the confidence to navigate it successfully. Let's start with a thought experiment. Imagine a magic box that generates $1 a day forever. How much would you pay for such a box? $1 million? $1 billion? While the idea of infinite money is alluring, let's approach this from a more grounded financial perspective. Think of a savings account with a 1.05% annual interest rate. To earn $1 a day, you would need to deposit a significant sum, around $34,761 to be precise. This illustrates the power of even small interest rates over time and highlights the importance of understanding the time value of money. Now, let's shift gears to a more relatable scenario, buying a house. Imagine a $100,000 house with a 20% down payment, leaving you with an $80,000 mortgage at a 10% interest rate. You might assume that yearly payments of $9,396 would clear the mortgage in 8 to 9 years. However, due to the impact of interest, it would actually take 20 years. This is because a large portion of your initial payments goes towards interest rather than the principal amount. This example underscores the importance of understanding interest rates and their long-term impact on your finances. To navigate the world of finance effectively, it's essential to grasp 3 key concepts: return on investment, ROI, the time value of money, and net present value, NPV. ROI is a simple yet powerful tool to assess the efficiency of an investment. It measures the return generated relative to the initial investment. For example, if you purchase a house for $100,000 and its market value appreciates to $150,000, your ROI would be 50%. While ROI is useful for comparing different investment opportunities, it's crucial to consider the time factor. An investment with a higher ROI over a longer period might not necessarily be more attractive than a lower ROI investment that yields returns more quickly. This brings us to the time value of money, a concept rooted in the fact that money available today is worth more than the same amount in the future. This is because money has earning potential through investments, and its value can erode over time due to inflation. To illustrate, imagine being given the option of receiving $1 today or $1 in 5 years. Choosing $1 today would be more beneficial due to its potential earning capacity and the avoidance of potential inflation. Finally, NPV helps determine the value of an investment by considering all future cash inflows and outflows, discounted to their present value. A positive NPV indicates a worthwhile investment, while a negative NPV suggests it's best avoided. Let's revisit our vending machine example. If the initial cost of the vending machine is $10,000 and it generates positive cash flows over the next 4 years, we need to discount these future cash flows to their present value to account for the time value of money. If the discounted cash flows exceed the initial investment, resulting in a positive NPV, then purchasing the vending machine would be a financially sound decision. Now, let's explore the exciting world of capital markets, specifically the stock and bond markets. Stocks represent fractional ownership in a company. Public companies like Amazon and Apple offer their stocks on public exchanges, while private companies are held by a select group of individuals. Companies issue stocks to raise capital for various purposes, such as expansion or inventory management. Bonds, on the other hand, represent loans made by an investor to a borrower, which can be companies, governments, or other organizations. Bonds have fixed or variable interest payments, coupon payments, and a maturity date when the principal amount is repaid. Unlike stocks, bonds represent debt rather than ownership. When comparing stocks and bonds, stocks tend to be riskier due to market volatility, but offer potentially higher returns through dividends and stock price appreciation. Bonds, with their fixed payments, are generally considered less risky, though they may offer lower returns compared to stocks. Valuing stocks, or any asset for that matter, involves considering 2 primary factors: expected cash flows and associated risks. Cash flows represent the net income generated by the asset, while risk refers to the potential for financial loss. Several methods exist to value stocks, including the discounted cash flow (DCF) method, which calculates the present value of future cash flows, and comparable company analysis, which compares the target company's valuation metrics to similar companies in the industry. Moving on to business strategy, it's about crafting a roadmap for success. A well-defined mission statement is crucial, encapsulating the company's purpose, target audience, and core values. Analyzing a company's strengths, weaknesses, opportunities, and threats, SWOT analysis, helps identify areas for improvement and potential growth avenues. Another valuable tool is the BCG matrix, which categorizes a company's products or services based on market share and market growth rate, guiding resource allocation and strategic decision-making. Understanding a company's financial performance is paramount, and this is where financial statements come into play. The three primary financial statements are: statement of profit or loss, income statement, summarizes a company's revenues, costs, and expenses over a period, providing insights into its profitability. Statement of financial position, balance sheet, provides a snapshot of a company's assets, liabilities, and shareholder equity at a specific point in time, reflecting its financial health. Cash flow forecast, statement of cash flows, tracks the inflow and outflow of cash within a company over a period, highlighting its ability to generate cash from operations. Analyzing these statements can be done through various techniques, including ratio analysis, calculates financial ratios using data from the financial statements to assess profitability, liquidity, efficiency, and solvency. Horizontal analysis, trend analysis, compares financial data over multiple periods to identify trends and patterns, providing insights into a company's performance over time. Common size analysis expresses each line item as a percentage of a base figure, facilitating comparisons between periods or with competitors, offering a standardized view of financial performance. Understanding how companies make large investment decisions requires delving into capital budgeting, a process of evaluating and selecting long-term investments that involve significant financial outlays. Companies invest in fixed assets like property, plant and equipment, PP&E, for various reasons, including increasing capacity, complying with regulations, and gaining a competitive edge through innovation. Capital budgeting ensures efficient resource allocation, aligns investments with long-term plans, and manages risk while maximizing returns. Companies finance investments through cash flow generated from operations, debt financing like loans, or equity financing by issuing new shares. Two crucial concepts in capital budgeting are internal rate of return, IRR, represents the annual growth rate an investment is expected to generate. Projects with an IRR higher than the cost of capital are generally considered favorable. Cost of capital reflects the opportunity cost of investing in a particular project compared to other investment opportunities with similar risk profiles. Three primary methods are used in capital budgeting. Payback period measures the time it takes for an investment to generate enough cash flow to cover the initial cost. Net present value, NPV, calculates the present value of future cash flows discounted at the cost of capital and compares it to the initial investment cost. Internal rate of return, IRR, determines the discount rate at which the NPV of an investment becomes zero. Now, let's shift our focus to macroeconomics, the study of the economy as a whole. It encompasses factors like economic growth, inflation, unemployment, and government policies. The business cycle represents the cyclical upswing and downswing in economic activity. Understanding the different phases, expansion, peak, contraction, recession, and trough, helps businesses and individuals anticipate economic changes and make informed decisions. Key macroeconomic indicators include gross domestic product, GDP, measures the total value of goods and services produced within a country's borders. Unemployment rate indicates the percentage of the labor force that is unemployed and actively seeking employment. Inflation rate reflects the increase in the general price level of goods and services. Interest rates represent the cost of borrowing money and can significantly impact economic activity. Governments and central banks play a crucial role in managing the economy. Governments implement fiscal policy through taxation and spending, while central banks use monetary policy by adjusting interest rates and controlling the money supply. In recent years, environmental, social, and governance (ESG) factors have gained significant traction in the business and investment world. ESG considers a company's impact on the environment, its social responsibility, and its corporate governance practices. Investors are increasingly incorporating ESG factors into their investment decisions, recognizing that companies with strong ESG profiles often exhibit better risk management, long-term sustainability, and the potential for enhanced returns. ESG considerations align investments with ethical and sustainable values, appealing to investors seeking both financial gains and a positive impact. Finally, let's touch upon portfolio construction and diversification. Diversification involves spreading investments across different asset classes, industries, and geographies to reduce risk. A well-diversified portfolio aims to mitigate losses by ensuring that the poor performance of one investment is offset by the positive performance of others. Investors can choose between active and passive investment management styles. Active managers attempt to outperform the market through stock picking and market timing, while passive managers aim to track a specific market index, such as the S&P 500. Beyond traditional investments like stocks and bonds, exploring alternative investments can offer unique opportunities. These include real estate, private equity, hedge funds, commodities, and more recently, cryptocurrencies and NFTs. However, these investments often come with higher risks and require careful consideration and due diligence. In conclusion, the world of finance and economics is complex and multifaceted. But by understanding the fundamental concepts, analytical tools, and macroeconomic forces at play, individuals and businesses can make informed decisions, manage risks effectively, and achieve their financial goals. That wraps up our exploration of finance and economics. If you enjoyed this deep dive into the financial world, don't forget to like, share, and subscribe to Simple Mind Space for more insightful content. Until next time, keep those minds sharp.